Hello and welcome to the Dry Powder Investing video blog. I'm Casey Hirth, and today we're going to look at a number of things. The S&P 500 has hit multi-year highs. Meanwhile, a lot of traditionally defensive, safe stocks are no longer safe. And also I'm going to look at 3 stocks in beaten down sectors that I believe can be bought right now. Thanks for joining me today. So the buying stampede continues on. Over the last couple of weeks, the Dow Jones Industrial Average has gone up for over 10 straight days, which for me is something that for me is completely unprecedented. I've been investing for about 6 years now, and I've never seen anything quite like it. So let's take a look at a more broad-based index, the S&P 500. And taking a look, we can see that it has there was a very slight pullback in late February. It really only dropped about 3%, and it has been up since then, and it looks like it's closed at about 1555. So we are in full-blown rally mode here. One peculiar thing that I found about this is that the defensive sectors have been leading this rally. And what I really want to focus on today is the consumer staples sector. These names are names you would associate with safety, such as Procter & Gamble, Coke, Walmart, Colgate, Philip Morris, names like that. This chart here says a lot. It's courtesy of Bespoke Investment, and it is more than 2 weeks old, but you get the basic idea. The green line here, as you can see, the green line is the trailing 12-month PE ratio, and the consumer staples are trading at a PE ratio of 17.69, well above their trailing 12-month PE ratio. That spread, that gap between the PE ratio and the actual PE ratio and the trailing 12-month is the largest spread of all the sectors at the time that Bespoke took this survey. So let's focus in on the XLP. The XLP is the Consumer Staples Select Spider. It is an ETF, and as you can, take a look at this. It looks like it's been just a straight up line since the beginning of the year. It closed at 39.30. It's well above its 200-day moving average, well above its 50-day moving average. It looks like the thing hasn't even caught a breath. It's just a straight line up. So why is this happening? Well, I think there's some money rotating out of cash and out of bonds, but people still want safety. And these are more brand name multinationals with good balance sheets, and so a lot of investors find safety in these stocks. What's really going on, I think, is the fear of a rate hike. See, interest rates are still very, very low, and I think a lot of bond investors are dissatisfied with those rates, and so they are rotating their money into stocks. They want a little higher dividend, and most importantly, what they want is a little bit of dividend growth along with safety, and I think they feel they can find that in names such as Procter & Gamble, Colgate, Coca-Cola, Philip Morris, etc. Eventually interest rates are going to go up. I don't know when, but eventually interest rates are going to be more close to their historical norm. And when they do, dividend yielding stocks that are similar to bonds, that trade in lockstep with bonds, such as utilities, for example, they are going to go down along with the price of bonds. As the price of bonds goes down, that's what drives the interest rates up, and the securities that trade in lockstep, the stocks that trade in lockstep with bonds, are going to go down too. And the fear is that the bondholders are going to get burned. So I think what's happening is money's rotating out of that and into stocks in safer sectors. And the particular reason why I think a lot of people are looking at the consumer staples is because most of them are multinational companies. They have good management, they have brand name recognition, and they have that magical thing called dividend growth, which is what separates the consumer staples from the bonds. It's really the big thing that separates them, because if you think about how a bond, if you think about the nature of a bond, the coupon payment of the bond does not go up. It is fixed throughout the life of the bond. But a lot of these companies, the Proctors, the Cokes, the Colgates, Clorox, I could go on, they have a long tenured history of raising that dividend payout year in and year out. And the bet is The bet is that once interest rates go up, these multinational consumer staples are going to be a safe haven of sorts because they're going to trade as a completely separate asset class. They're not going to get ravaged by bond prices going down because they have that trait of dividend increases year on year. And that's a perfectly fine rationale. That's a perfectly fine rationale. I just think that at these prices, that margin of safety, there really isn't any margin of safety. And at these prices, the risk-reward isn't justified anymore, and in fact that these are no longer safe stocks. It's a lose-lose situation because good economic news will probably cause money to rotate out of those consumer staples into less defensive names, into more cyclical stocks. But conversely, bad economic news could cause a lot of these stockholders to scurry right back into bonds, which is probably where they came from in the first place. Contrarian investors and value-minded investors, if they even want to buy anything up at these levels, need to be looking at more beaten down sectors. And right now, the two most beaten down and the two most reasonable sectors, relatively speaking, are energy and materials. So let's take a look at that. Again, here is the bespoke chart that looks at PE ratios and the trailing 12-month PE ratios. We're taking a look at energy first, and that has a much more reasonable PE ratio of 12.47 right now. Now remember, these are cyclicals, so it's not, the PE ratios are not going to be as relevant. But you can see it's just about at its 12-month trailing average, price to earnings average, and it looks like it just bounced off of it recently. So energy looks a lot more reasonable than consumer staples. Let's take a look at the materials. Materials is looking even better. They're trading right now at a PE ratio of 16.77, and they're right about at that green line, the 12-month moving average. Taking a look at some of the weekly charts, let's take a look at the Basic Materials ETF. That's the ProShares Ultra Basic Materials, ticker symbol UYM. And this is the daily chart, and it dropped very substantially in late February on that on the mini pullback, and it has since come back. And to drill down on both of these sectors, we can find some very reasonable deals that are still around. So a first long-term favorite of mine is ConocoPhillips. They are a newly independent oil and gas company. They recently split off Phillips 66, and let's take a look at their daily chart here. Stock is trading at 60.91. It has come up a little bit within the last week. If you see, some of the most recent price action has been a gap up on a substantial oil discovery in the Gulf of Mexico. ConocoPhillips, they're repositioning themselves. They're selling a lot of their African assets, their Central Asian assets that they acquired at the turn of the millennia, and they are refocusing on higher margin, higher growth plays right now in newer oil fields in North America and other OECD countries such as Norway, the UK, and Australia. And that's where the higher growth is right now. Currently, ConocoPhillips has a dividend yield of 4.33%. I mean, that outstrips pretty much any consumer staple stock that I can think of right now. It's paying you a lot to wait, and there's going to be a lot of really good future oil production growth coming online late in 2013, all through 2017 and probably beyond. So ConocoPhillips isn't quite the good deal that it was a couple weeks ago, but it's still very reasonable, and you're still going to get paid to wait. I strongly suggest that you consider ConocoPhillips here. Here's another one that I like, and American listeners might not be too familiar with. It's called BHP Billiton. BHP is a diversified mining company that is headquartered in Australia, but they do list on the NYSE. Resource company. They produce, just off the top of my head, iron. They produce metallurgical coal. They produce energy coal. They're into petroleum now, and they produce a lot of aluminum and manganese. So they really are a very broad-based resource company. Currently, if you buy BHP's shares listed on the NYSE, and that's ticker symbol BHP, you get a dividend yield of 3.27. That's very, very reasonable. Take a look at the daily chart here. Oh, no, I beg your pardon, it's the weekly chart. It's the weekly chart, and it goes all the way back to October 2012. And the stock is really down on its luck. It had some, like all miners, it ran into some headwinds from stronger Australian currency and from lower realized prices of many commodities, especially aluminum, or aluminium as they say over in Australia. So the stock price is way down, and you don't really need to worry too much about it. They've got the whole thing under control. I've looked at the balance sheet myself. This is a very long tenured company. They've got great management. They're an excellently managed company. And if you're looking for a baby that is thrown out with the proverbial bathwater, I think that BHP Billiton is really a good. And last but not least, we're going to look at PotashCorp. PotashCorp is a Canadian miner of fertilizers, and this is a really good story. They produce their primary fertilizer they produce is their namesake, which is potash. You can't really find potash in too many places in the world, but it is the most high quality fertilizer. And the world is getting hungrier and hungrier. Populations continuing to grow, and developing countries are becoming more protein centric in their diet, which means that farmers are going to need a lot more wheat. To get that higher crop yield, they need the higher quality of fertilizer. And potash is the world's biggest producer of fertilizer. The world's potash market is controlled by two cartels. One is a Canadian cartel, and the other is a Russian and Belarusian cartel. And so it's a duopoly. Supply is very limited, and this is the biggest producer of potash in the world. Let's take a look at their weekly chart, and as we do, just before we jump into it, I want to let you know potash, the shares listed on the NYSE currently yield 2.83%, so it's not a bad dividend yield. Take a look here. This is the weekly chart. It goes all the way back to 2010, and it's not quite as down on its luck as BHP Billiton, but you can see that it's trading just below its 200-day moving average, and it's right about at its 50-day moving average. This is a really good entry point for a fantastic company, a very well-managed company, and a company that is set to grow for years to come. I have written an article on Seeking Alpha about these three stocks, and the link to that is below. I cover these three a lot more in depth than I do on this program. I encourage you to click the link below and read my article there. It is completely free. I don't even think it requires any kind of registration. You just click and read it. Also on Seeking Alpha, I've previously written an article on a number of consumer staple stocks that I think are overvalued. Again, the link is listed down here. Just go ahead and click it and read it. There's really no hassle to it. I encourage you to do that. And also, I have a almost weekly blog on The Motley Fool where I cover value stocks and things that I think can be bought. If you like what you see here, go ahead and click that. I hope you enjoy it. And until next time, sleep well at night.